it's at least match the old highs, and everybody will think it's overdone there. They think it's overdone the whole way up, and I love that because that keeps it going. If everybody's on board, and we know that the Western world, especially the U.S., is not on board, the average investor. When they finally get in, it's going to be a wet bar of soap type phenomenon. Especially silver. My own personal conviction, my personal positions in markets heavily emphasize monetary metals, but especially silver. Now, on this page, we show the gold miners going back to 2013 versus S&P. They've also broken out. We don't look at the fundamentals as such. There's some meticulous analysts who look at each currency unit and the government spending and all that. We view it as one big team of slush, okay? And the issue is which one sinks faster than the others. And it's hard to believe that the dollar index is worse than the euro and the yen. They constitute 70% of the dollar index. Euro is 57% of the dollar index. So it's really not much of an index. It's two currencies against the dollar. You got the Canadian in there and a couple others, and the British pound and so forth. But really, it's the euro and the yen. And it's hard for me to say the dollar looks weak compared to those two pieces of paper. But that's the game we're playing. We're playing with three pieces here, essentially, of worthless, ongoing, decaying money units. Okay, yeah. So it's hard to me to be boisterous about any one of them. To say, oh, the euro looks good. You get my point. Okay.
I get it.
Okay, yeah.
But what you're saying as well, maybe to paraphrase, that the momentum is really picking up and dollars decay.
The momentum breakage, when you can see a structure on a momentum chart, like, a good trend line. Like if you saw it on the price chart, the uptrend was hit 4 times, let's say, and then the 5th time you broke it, you'd say, I better sell that, right? Okay. Well, that happens on momentum usually almost all the time before price smacks you in the face with a similar move. So that's why we're focused on momentum. It usually leads trend changes. In this case, we're talking about an annual momentum trend change. Those trends tend to last, not just 6 months or so, but, several years. And what the dollar's been doing, since Nixon's time is nothing but big slabs of decline relative to these other pieces of junk. So, and again, to try to link it to the gold movement is not if you looked only at the dollar index since 2015, it's been above that level and below that level. So what did you do? You don't buy gold, right? Because the dollar's just sideways. Well, you missed a 4-fold move in gold if you did that. So it's hard to utilize that information in that way. But the one correlation that we have noticed is that some of the big swings in the dollar index, like the dollar index peaked in early 2000, .com top, dropped to 2002 low, .com collapse, S&P. Made a low about 6 months before the stock market in 2008. Stock market bottomed in March 2009. They've both zigzagged higher since that low in 2008. And a lot of the swings are fairly well coordinated. In fact, look at the March-April break in the dollar, which was a sharp drop. Same thing with the S&P. The difference right now is the diversion in the strength of the rally. The dollar's anemic, S&P's teasing everybody. But if that dollar is really breaking down, as we argue, then these broad trends argue, maybe the S&P is going to join it again. Just a sideline factor to pay attention to.
While price charts attract the spotlight, momentum charts reveal trend changes before they appear in the headlines. A powerful momentum break often occurs months, sometimes years, before markets recognize that a major cycle has reversed. Today, long-term momentum indicators for the US dollar are breaking structures that have held for years, signaling sustained weakness ahead. Historically, when annual momentum weakens, multi-year downtrends follow. The dollar has already experienced several long declines since the 1970s, and current momentum deterioration suggests another significant phase may be starting. This shift has broad implications for commodities, equities, and the global search for safe stores of value.
Yeah, well, what you're looking at is a spread chart, meaning I divide an ounce of gold. I use the front month active COMEX future. Right now, that'd be the February 26th contract. December's in delivery, so we rotate to the Feb. So the February gold contract, which right now is 42.40, I think, as we speak. But last month, these are monthly closes you're looking at here, are plotted. What's the price of gold expressed as a percent of the price of the S&P? And you just simply plot those charts every month. Here we go back to 2013, and that was the year in which gold, after the 2011 high, really started to implode in 2013. And naturally, its relative performance to the S&P, this spread chart, was in collapse mode as well. Okay. And by the time you got to late 2015, that spread dropped down to about 50%. That's on the left side of that chart there, where the first low, just above 50. And gold at that point, if you draw a line sideways from late 2015 on this spread chart, you'll notice it's been above and below that level, zigzagging for 10 years. So almost you could say gold's been par to the S&P in terms of performance. Sometimes better, sometimes worse, but net on balance at that, let's say that low in 2015 at about 51%. It's been either side of it. So you could have flipped the coin back in 2015 and bought gold or bought the S&P. And for most of those years, you'd be making money or losing money or making money, nothing, in other words, okay? Right now, what's happened is that close in November took out a 1, 2, 3, 4-point trend line, almost flat, across every single rally high in that spread, going back to 2014 rally, in late 2014, its first peak. That is a beautiful trend line. If this were a price chart of ABC stock, and you broke out over that line and you were looking at the price chart, what would you say? Oh, we have a breakout. I got to buy that thing, okay? This is a fresh breakout. What it's saying is, yeah, we've seen strength in gold since early 2024, actually. You can see it spread went from 40% up to 60. But it's only just now broken out. So this game is really just beginning. The movement of money into gold, monetary metals, and out of the stock market. Important chart.
Although the dollar and the stock market don't always move together, their major turning points often rhyme. The dollar peaked near the dot-com boom in 2000 and bottomed after the crash in 2002. A similar pattern emerged around the 2008 financial crisis, when both the dollar and the S&P 500 pivoted within months of each other. In early 2024, another divergence is emerging. The S&P appears resilient, while the dollar shows structural weakness. Historically, such divergences resolve with equities eventually following the dollar lower. If the current dollar breakdown accelerates, it may signal the early stages of a broader equity downturn.
Very, very important, absolutely, because it sort of signals a little bit what the banks have been trying to tell us here as well. It's just building on that, the 60-20-20. I'm very sure you've heard about that as well.
Yeah, I heard that. Yeah. They should have reversed it, though. It should have been 60% gold, 20-20. Okay, but anyway.
I was going to say, let's not get too greedy here, but that's part of the momentum game, isn't it? Like, is that something you're tracking or looking at, like influencing momentum? Is that picking up now?
We run momentum studies of these charts too. In fact, later on we'll look at one regarding silver. But the point is that when you get this kind of breakout, and its momentum has also done the same thing except earlier, it's saying something big. It's saying this is a monstrous base of monetary metals holding their ground versus the paper bubble. Everybody's cheering the stock market for the last 10 years, but nobody's noticing that you could have flipped the coin every 6 months and either been ahead or behind in gold relative to the stock market, but basically net sideways, meaning as well as the S&P. Nobody notices that. And I love that because they notice it later, But anyway, this is a breakout and it indicates something. You're not going up for 2-3 months here. This is going up for a couple of years. And God knows where it's going. But this is a massive base that will have a massive move, and it just began. So people who look at a gold chart say, oh my gosh, that's so steep, it's gained so much ground. They need to step back a bit. And another thing about gold, if you go back for the last 50 years since it was legalized in the U.S., you've had two bull markets that were eightfold, bear low to bull high. There's 1976 bear low to 1980 high, 2001 to 2011, both were eightfold dimension gains from low to high. We're only fourfold. Our low was 1,050. We're 4,200. You go about mid 8,000 area and you can say, oh, I've at least matched the two prior bull markets in terms of dimensionality. So even on that metric, gold is hardly overdone.
When comparing gold to the S&P 500 over the past decade, the relationship has been surprisingly balanced. Since 2015, gold has spent nearly equal time outperforming and underperforming the stock market. This decade-long standoff formed a massive technical base, a foundation that often precedes long, powerful trends. Recently, that equilibrium broke. Gold has moved decisively above a multi-year performance ceiling, suggesting capital is beginning to migrate away from equities toward monetary metals. Momentum indicators confirm this breakout, implying the shift is not temporary. Historically, such performance breakouts have led to gold bull markets lasting several years and delivering transformative gains.
It's at least matched the old highs, and everybody will think it's overdone there. They think it's overdone the whole way up, and I love that because that keeps it going. If everybody's on board, and we know that the Western world, especially the U.S., is not on board, the average investor. When they finally get in, it's going to be a wet bar of soap type phenomenon. Especially silver. My own personal conviction, my personal positions in markets heavily emphasize monetary metals, but especially silver. Now, on this page, we show the gold miners going back to 2013 versus S&P. They've also broken out. Then the bottom chart there is silver price divided into S&P going back to 2013. You also had a downtrend. You broke out above it too. So all the monetary metals and their miners just broke out over an 11-year wide performance base. It's just begun. It's not just gold. It's the miners as well. It's silver. Monetary metals and their miners have shifted into bull phase versus paper bubble. And the next page is the most illuminating of all, if you want to do that one.
Absolutely.
Okay, the top chart is back to 2020. Silver versus gold. We divide an ounce of silver into an ounce of gold, express it as a percent. And back then we were under 1% in early 2020. And it exploded to 1.5% in a matter of a year. That was during that 2020 surge in the monetary metals. Gold went up 40%, silver doubled. So the spread increased. After that, silver, though going up in price mostly, had an erosional backing off on the performance. And it developed a downtrend and also a green horizontal ceiling. It blew through both last month. It's fully broken out of a massive base that goes back to 2021 on that green line, which is the most important one. So not only are the monetary metals now going to beat the S&P, but within the monetary metals, silver is going to lead gold, is our argument. And I have certain expectations of silver that are rough, but at minimum, I think you could see $200 silver in the next 6 months or so. Sounds lunatic? No. There's many other historical comparisons where other markets have done comparable events with far less fundamental driving factors than silver has right now. And it wouldn't shock me to see silver at some point in the next couple years during this, what I think is an oncoming crisis, to be $1,000 an ounce. God knows where gold might be at that time. It might be highly likely to be institutionalized as a money unit again. This country, that country. A growing contagion of people saying, hey, this fiat stuff hasn't worked. We've been playing with it for 100 years and it's just created boom busts. Let's go to real money. It takes pain to cause that kind of rethink, but I think that's what we're about to step into.
Among monetary metals, silver is emerging as the potential leader. Its performance against gold just broke a multi-year downtrend, signaling a structural shift. Silver is historically explosive once momentum breaks. In 1979, after a similar signal, silver nearly quintupled in months. In 2010 and 2011, it doubled rapidly. Today's fundamentals are even stronger. Industrial demand from solar, electronics, and energy storage is hitting record levels, while global supply has run deficits for years. As investors seek defense against currency decay and market instability, silver's appeal grows. Technical and fundamental forces now align, suggesting silver could enter its most aggressive repricing cycle in decades.
Okay.
Let me talk about this chart here. If you take this one back 50 years, everybody looks at the ratio scale. Fine, it's fine. It's just an upside down version of this. The Bull market in 79.80 took silver to 6.5% of the price of gold. Okay. The bull market in 2010-11, when silver hit $50 again, was at 3.5%. Right now, this chart is not up to date. Right now, we're pushing up toward 1.4%. But even 1.4 to go up to 3.5, which it was during the last bull market, is a huge gain. It's almost tripling in the relative value of silver to gold. God forbid you go to the 1980 peak reading, which would have 6.5% the price of gold. And silver's not going up, by the way, and gold's sitting still. So as we're measuring silver relative to gold, we're measuring silver versus another rising market as well. So it's kind of hard to tell. We think this spread is likely to go in this surge up to at least 3%, meaning silver should at least double and a half. And once the spread breaks out, by the way, which it has just now, silver gold, you go back to 79, you'll see a similar incident in the summer of 79. 5 months later, silver quadrupled to almost quintupled in 5 months. 2010 to 11, the last 7 months of that bull trend, silver doubled and a half in 7 months in net price. Think about it. And then realize
now we have social media. So the trend is going to, the time frame is going to be much shorter.
Bigger crisis. We have a much bigger crisis.
Yeah.
Silver's headed for a new reality. That's what's happening.
No. Now it's interesting. Maybe to summarize a little bit, what you're saying is like gold should double from here, meaning let's say from
absolute minimum. I
right?
don't know where that's a joke target because it's laughable because we've done it twice before, so it's not even exceptional. Okay, there you go ahead. This is my position. Everybody's different because everybody has either more money, less money, more time sensitive, less time sensitive, doesn't want to do leverage, etc. I'm entirely in silver portion of the monetary metals. I own calls on SLV. AGQ is a double ETF of silver. I own that. I own the top 4 biggest silver miners. I also have long-term or leap calls on the top 4 big silver miners. I own about 7 or 8 junior miners, and I'm likely to increase that. I think in particular, as silver explodes, the silver miners will go absolutely berserk. They are vastly undervalued to gold miners. And you'll see on the bottom chart there, that's SIL versus GDX. That's the silver miner ETF versus GDX, which does contain, by the way, some silver miners. Look at that spread. It's crowding for the last 4 months, that green line. And right now, I think you're marginally above it. This is as of last month's close. So when that breaks out, the silver miners versus the gold miners, that's when you're going to see an echo effect of what silver's doing versus gold, breaking out. In which case, the best place to be among the miners should probably be some emphasis on the silver miners. I think they have much more potential percentage gain. And it could be very dramatic. I don't just mean doubling, if you know what I mean. I mean dramatic. And it's a tiny little sector. As the money flows into it, it skirts it up.
It is a tiny sector, Michael. It's really difficult to find pure play silver companies anyway. I think there's 3 at best.
Well, there's a lot of juniors.
That, right?
Yeah, there's a lot of juniors, and unfortunately, fortunately for silver, the fundamental is that most silver doesn't come from silver mines. It comes from base metal miners who produce silver on the side as a marginal product. Hence, their primary motivation or profit-driven factor is the price of copper or the price of some other base metal, not the price of silver. It doesn't motivate them to mine more copper to get the little bit of silver they get out. So the silver miners are highly focused little beasts that even if they're tiny little guys, and maybe the cost of production at $30 an ounce was not really good for them. Now suddenly we're pushing towards 60. What if suddenly you're 150? Suddenly these once seemingly worthless little mines, which have the real thing under the ground, think about it that way. They got the bullion under the ground. Suddenly are perceived to be, holy cow, I'm buying this little junior miner. What I'm really doing is buying bullion at 10 cents on the dollar. Okay. So that's why my emphasis is there.
If silver enters a major bull phase, the greatest upside may appear in mining stocks, especially small and mid-cap producers holding vast underground reserves. Many silver miners have lagged gold miners for years, creating conditions for dramatic catch-up rallies. Some analysts argue silver could double, triple, or more as its gold ratio normalizes toward historical peaks. In a broader sense, rising precious metals hint at deeper systemic pressures. Nations are already exploring asset-backed currencies, and central banks are accumulating gold at record rates. If crises accelerate, a global reevaluation of monetary systems and a return to tangible value may unfold sooner than expected.